We're currently at one of the most critical points in one of the darkest moments in financial history, with stocks breaking to new lows, the Japanese and UK bond market becoming completely untethered, CPI forecasts for tomorrow's release predicting another increase in inflation, California gas prices hitting all-time highs, and OPEC cutting production to send oil prices even higher, the Bank of England giving pension funds 3 days to, quote, sell everything, and trusted macro experts being worried about things being even worse than 2008. Meanwhile, Bitcoin has been stuck in a range for nearly 4 months, and bonds have been moving like Dogecoin. And of course, Ben Bernanke, who created this whole mess, just got awarded the Nobel Peace Prize. Which begs the question, will the financial system actually break this week? Now, spoiler alert, that's not actually what I believe is going to happen. In fact, I think it's very unlikely that the financial system breaks this week, but there is an insane tsunami of bad news piling up, making this one of the most FUD-fueled moments in financial history that certainly I can remember, and based on the timeline, it seems like many macro experts are in the same boat. This video is brought to you in partnership with my skyrocketing anxiety. I'm just kidding, but let's be real, it's definitely a weird moment in the economy. I do believe that all of this ends up resolving itself in time, but patience and caution, which we've been preaching here on the channel for months and months now, is by far the best strategy. So if you guys have been enjoying these videos and you understand how much time and effort goes into preparing for videos like these, then please smash that like button. It takes 2 seconds. It shows me and the YouTube algorithm you enjoyed the video. With that said, if you want more videos like this, make sure you subscribe, put that bell notification on, and with that said, let's dive in. Now, if you remember, we had a video last week called Bounce or Die. Yes, amazing publishing and amazing titling, I know. Well, we didn't really get the bounce scenario we were looking for. In fact, we had 2 vicious bounce days, but they faded so quickly that many experts in the field believed that the bull case was almost all but evaporated for the short term. Now, remember what we've been saying is short-term gain, meaning long-term rallies, only extends this dark moment in this bear market. We really need to get the FOMO out of the system, to crush demand, to see what the real lows of this cycle will be, and that will allow the Fed to start pivoting and saying, hey, mission accomplished. We've crushed demand, we've controlled inflation, and now we can start easing back up on the economy instead of absolutely destroying all kinds of demand and liquidity. With that said, in this climate, crypto prices have maintained a pretty significant level of stability. Meanwhile, the stock market has had vicious downside. As you can see here, October has been an absolutely brutal month. Even starting here on October 12th, the S&P 500 has crashed from a 4 handle here to 3,600 level. Meanwhile, you can see that we have been 117 actual days here in this range for Bitcoin. That's almost 4 months trading just completely sideways. I'm sorry, but I can't help but be reminded of the 2008 bear market, where we really stabilized here and started hitting the 6K level here back in June of 2018. Remember, we hit our recent bearish levels in June of 2022. And here we saw, yes, we did have this massive rally up to, 8K. Remember, we did have a rally up to 25K, and then we came back down, tested these lows, didn't quite make new lows here. It kind of feels like the price action is somewhat similar to this 2018 era. And remember what happened after that was we had true capitulation, which happened after 6K all the way down, bringing the ultimate clearing price of Bitcoin just above 3,000. So even though everyone was calling this a bottom, I remember it clear as day. Everyone was saying this is the bottom, bottom's in for sure. We're going to make our way up after this. And then we got the ultimate capitulation here. And this phase actually lasted for several months here. As you can see, we didn't quite make it out of this until March of the next year. So we had pretty much from, November, December, all the way through March, all of these lows. And this was the ultimate bottom here in 2018. And so as we've seen this range kind of persist here, you can't help but feel that this is starting to smell quite a bit like 2018. Does it mean that we have to capitulate again? No, of course it doesn't. But even in the 2018 moment, we didn't have these macro forces of the Fed and everyone trying to suffocate markets like this. We have even more working against us than we did in 2018, which is why this kind of boredom in a bear market like we're experiencing, at the stage we're experiencing it, just can't help but give me flashbacks. Again, you could be a hero and try to bid this Bitcoin all the way up, but as I've been saying, the only real safe, secure way to do this is to either wait and be patient and just let time play out until the market starts to recover, or you could dollar cost average, meaning you put little bits of money into Bitcoin and Ethereum each week, you set it and forget it, and that way you're essentially diversifying your risk over time. You're not actually lumping all your bets in at one moment, where your risk is that that time period will actually not be the right price to buy at. So I can't help but get flashbacks of 2018. I was waiting for a level to emerge that felt like 2018's 6K, and I hate to say it, but I feel like we're at our 6K level right now. Let me know in the comment section below, what do you think of this comparison between the levels we're at right now, this sort of eternal sideways boring that we've had, and how does it compare to that 2018 moment? Let me know in the comment section below. Of course, I believe we're in an entirely new ballgame, an entirely new type of bear market, where it's not just a Bitcoin native unwind, but we really have this macro storm. Let me know in the comment section below. Even though the past does not predict the future, it's always good to look at historical examples. Speaking of historical examples, what you see here on the white is actually the 2007-2008 S&P 500, and this is overlaid on it today's market. As you can see, we're so closely parroting this type of price action, it really begs the question, is this an exact great financial crisis redux? Is this the same thing all over again, and we're just waiting for the Fed to come in and save the day? Again, nothing ever exactly repeats itself, but this is kind of staggering. Does this mean that we're headed way lower, under 3,000 levels here for the S&P 500? I'm curious what you guys think in the comments below. Meanwhile, it's important to realize the treasuries market, which is supposed to be one of the most stable markets on earth, is now more volatile than Bitcoin. That's right, according to some, the Fed finally broke the market, and the most volatile assets on earth are less volatile than the 30 biggest stocks on the planet. And as we've been telling you, the issue here isn't with individual banks like it was in 2008. No, the issue now is at the sovereign debt level, with treasury markets absolutely going berserk. First, it was the Bank of Japan, who then stepped in and started buying their own bonds. As you can see here, the Bank of Japan stepped in and lowered the value of its own bonds, controlled the yield curve. England did the same thing, but even with buying, we're seeing that both of these bond markets are creeping up back to the levels where they had to have government intervention. Definitely give Dylan LeClaire a follow here. He's been absolutely crushing the content covering this market. As always, each era of this market in crypto brings new personalities and new figures that are creating incredible content and bringing amazing information that helps everyone navigate. Dylan is certainly in the class of 2022 All-Stars. Shout out to Dylan. Please give him a follow. His information is top notch. And in an absolutely shocking turn of events, the Bank of England, which has been buying their own bonds in order to save the UK pensions and insurance funds, literally said this: you have 3 days left. 3 days before they stop purchasing the bonds. That's right. Purchases will end on October 14th. This temporary gilt purchase, gilt is their bond market, this will end on October 14th. They literally told the UK pension system to sell everything in 3 days. It's almost unthinkable that the bank of a country, a central bank, would look to an insurance and pension fund system and say, get it all out, fire sale right now, because we cannot ensure that you will not get margin called, and we cannot stop the tsunami, so please sell everything. That is one of the craziest pieces of news I've heard in a very long time. Now, they did say that beyond October 14th, there are like new liquidity measures in place, but this is a new step, a new level of crazy to hear a headline like that. It was almost so much that I had to double and triple check that this was not some kind of meme, some kind of joke. 3 days, sell everything, pension funds. Good luck, have fun.
It is history now.
Meanwhile, one of the trends that I've been studying is, unlike a lot of the commentators on Twitter, myself included, that tend to be more excitable in one direction or the other, to the upside or to the downside, there are a lot of seasoned OG macro experts that seem to be legitimately concerned that this could be worse than 2008. Take, for instance, Dr. Kitty Kitty Bang Bang. I'm joking there. Carlo Cassio, though, is a very, very well-respected macro analyst. I've been using a lot of his tweets and research in my own content. If you haven't noticed, please give Carlo a follow here. He's one of the Hall of Famers here for the 2022 bear market. Carlo says, why is this unwind much more dangerous than 2008? Because what caused 2008 was banks' leverage. That was a relatively easy fix. Today's issue is much wider and policy-driven. Monetary policy since 2008 is directly the cause of massive risk-taking. Of course, we'll talk about the irony of who created the solution to 2008, what problems were in because of it, and what happened to this person. Again, the irony overwhelms, but more on that at the end of the video. It just so happens that today is a very special day because we're staring down the barrel of yet another big week in CPI, meaning that we're going to get to find out what the numbers were for consumer price index inflation or deflation tomorrow. That's right, drumroll please. We have yet another massive day of volatility ahead of us. And actually, I was pretty shocked to see that the forecasts have inflation increasing despite all of the efforts by the Fed to bring inflation down. We see that month over month, inflation is steadily creeping back up towards its all-time highs. Here we have extremely well-named correspondent Bob Elliott here saying today kicks off inflation for September. Data baked for September-October shows stable 6% core inflation shown below. Over the next 6 months, core CPI might ease to 5.5%, but that's still too high for the Fed. As you can see, this is the month-over-month change for inflation, and we see CPI coming in here at an increase of 0.72%, CPI going up, PCE going up, core PCE coming up. Repeat after me, this is not great. And one of the biggest things that we need to understand is it's really about surprises in the market. We can see that when consensus predictions are actually wrong and inflation surprises to the upside, that's way worse than inflation being accurately predicted when people get a sense of calm, like the market really knows what it's doing. Right now, Prometheus Research predicts that CPI will increase 0.36% month over month, while consensus expects a 0.2% increase. So this would be almost double the consensus prediction, which is very, very bad. The less surprises, the better. The more the market gets a sense that it's accurately predicting the inflation crisis, the more the market feels like stocks and cryptos and equities are accurately priced. But when inflation surprises to the upside, that's when everyone says, wait a second, if we can't predict inflation right, then are we predicting the stock prices right? Again, I've said this before, nothing is priced in. Nothing. That's because it's impossible to predict a lot of this stuff. Even one day before CPI comes out, we are still scrambling, trying to figure out and predict what it might be. Again, if we can't even predict accurately last month's inflation numbers, then how are we supposed to know how this entire thing plays out? But I do want to be clear, there is a glimmer of hope here. We are not just all doom and gloom here on this channel. I know this has been a stressful episode, and believe me, I feel the stress and anxiety of this moment too. But I do believe that following these trends, understanding them, educating on the macro will lead to understanding when the time is right to be buying the generational lows, because this, I believe, is one of the biggest opportunities that probably anyone will have in our lifetimes to participate in financial markets. Crisis breeds opportunity. Remember that. And one of the things I found very interesting as we've been covering the real estate crisis and how housing prices absolutely must come tumbling down and will very soon, I believe, inflation won't start rolling over because of used cars, commodities, lumber, any of these junk indicators that all comment redacteds have been peddling for months now. It will be because of mortgage rates. That is the key. And of course, it makes a lot of sense that the cost of housing is one of the most key indicators, the most fundamental cost of living in the world is the cost of laying your head down in a safe and secure domicile. So the cost of housing, the cost of mortgage rates, all of those things will predict and indicate when inflation will actually roll over. I think this is a bold and a very interesting prediction. Meanwhile, and we're not going to go too deep into this because you know the deal, the energy crisis is getting dramatically worse, with California hitting record highs on gas prices, and we see fights breaking out across Europe at gas stations. While I do believe that memes will get us through this, it's important to realize just how dramatic the situation is, and when energy is unattainable, when gas isn't there to fuel cars, when there isn't food, this is when dramatic things happen in government. Again, everyone is living through these incredible and crazy times together, and I'm going to do my best to synthesize the data and give it to you no matter how good or bad that data might be. And meanwhile, the architect of quantitative easing, starting from the great financial crisis, Ben Bernanke, just won the Nobel Peace Prize, and as Michael says, you really can't make this up. Let's pour one out for when Bernanke predicted in January of 2008 that there will not be a recession. Again, you can't help but think about today, as Jerome Powell and the Fed have been predicting a soft landing, no recession now for months and months and months, when literally everyone can see the writing on the wall that this economy is headed towards a very, very, very significant reset, if not a recession. Again, I'm not the expert. I'm not going to call a recession, but it certainly feels like all signals are pointing that way. Now we're going to do a follow-up to this video on how this could actually be worse than 2008. Again, I'm not trying to be a doomer here. I've been screaming about the absurd downside scenarios here for quite a while now, and I think we're almost all on the same page about this. Again, being bearish in a bear market is the accurate response. Being bullish in a bull market is the accurate response. Finding the exact moment to pivot is for those intergalactic geniuses, which I've never been great at, and I'll do my best to get better. But overall, spotting the trend and moving with the trend is the ultimate goal. Now, here's the silver lining, because you know I'm never going to make a video without a light at the end of the tunnel. That's right, I'm an optimist, and I do believe that this all results in some ultimate opportunities for bottom buying, generational lows, and the type of portfolio construction that people will look back on and go, oh my God, those lucky people who bought during that moment. And it's never really luck, because look around us. This is insanity. The people who end up buying these lows will most likely be called crazy at the time. But it's important to realize that the Fed will blink. The Fed will change their tune. The Fed will do what they do best and start printing money once again. They will most likely be the last country on earth to do so. They will do their best to strengthen the dollar and keep it as pristine as possible for as long as possible, because they're going to need that strength as they start to print and solve the world's problems with more and more and more money. I happen to agree with Chris here that the Fed will blink when the market finally comes to believe that they won't. Again, the bear market bottoms when people forget that there's a possibility of a bull market. The bull market ends when people forget the possibility that there was ever a bear market. That's certainly what happened even to me at the end of 2021, and I believe it'll happen in the not too distant future. Again, exactly when depends on way too many factors. But once that happens, treasuries will go no bid, meaning that people will lose confidence in the bond market, and that's when the Fed will have to step in. So with all this in mind, remember, patience and really doing nothing, staying on the sidelines, is one of the absolute best things that anyone could have done in 2022. Obviously, shorting from the top of the markets is great, but once we reached this sort of middle ground within the markets, shorting became an absolutely disastrous and dangerous affair, and I urged everyone not to do it, because once it's so obvious that the short side is profitable, well, it stops being profitable. Now that said, what am I looking for? I'm looking for the moment where the Fed pivots, where they blink. They will make this very clear, and when they do, it'll be time to start loading up the bags once again and riding another long generational trend of bullishness. Again, I'll be here each and every step of the way, bringing you the analysis and updates to help you better understand what's going on in these global markets. Because once that happens, Bitcoin and cryptocurrency, I believe, will be the fastest horses to run away on this risk-on environment. In fact, there's still an opportunity for Bitcoin in a world with growing tensions between the West and East. The idea of an independent currency, an independent fungible asset like Bitcoin becoming the actual true global reserve asset is something that's still possible. And what's good for Bitcoin is good for the entire crypto ecosystem. With that in mind, every single thing we've covered today has everything to do with crypto. And for that reason, we'll continue covering the macro. We'll continue covering this entire moment with an eye on buying the generational lows, building a portfolio for the next 10, 20, and 30 years. And if that's a value to you, please smash that like button. Make sure to subscribe for more videos, as we're going to be doing our best not only to cover this market, but to talk about skills and habits that I'm going to be using throughout this dark moment in the economy to make sure that even when the bags aren't moving, I'm moving and progressing in my own personal career, and believe these are things that everyone can take advantage of. So make sure you subscribe for more videos. As always, I thank you so much for watching. I believe that as a community, we can get through these crazy times together, and I'll see you very soon on the next episode.